much. Thanks to the organizers for inviting me, and thank you to the sponsors. And thank you for being so many in this room. Predictive analytics in the investment industry is the title of this presentation. I will run through it reasonably fast in order to allow some time for Q&A. So the strategic scope, as I say, it's an overview and an outlook of where we stand according to my view, and I hope you will find it moderately provoking and maybe a bit challenging. So the question here, has big data failed to deliver on its hype? That's the first thing. So who would agree that big data has failed to deliver on its hype? Raise a hand. No one. Okay, interesting. Maybe it depends on what we mean with big data. And I would subscribe to a definition that is data so large or complex. Too large or complex for traditional processing methods. So it's not necessarily big by definition, it can also be complex. People talk about all these V's, velocity and stuff like that, but I'm going to go a little bit beyond that. So in my mind, there is a general blur when we talk about big data analytics. Are we talking about big data, or are we talking about advanced analytics? Where does machine learning come into play? Machine learning has actually very little to do with big data analytics, in my view. You can use machine learning or pattern recognition on very small amounts of data. Then when we talk about predictive analytics, it's so easy to throw in this little prefix, big data. Like we do if we're a software vendor. We can sell the same sort of database management systems as before, or the same system integration solutions and stuff like that, and we just add on big data as a little prefix. Modern companies, of course, they want to know everything about their connected customers. Who they are, where they are, who they work with, work out with, sleep with, etc. Why? So they can stay one step ahead of them, predicting their next move, finding out what they're looking to buy, when, why, from whom, at what price, in what color, etc. Basically anticipating what the client wants to do on an individual level, even before the client knows it themselves. And the bulk of the efforts in this space, if we look at, for instance, online companies, businesses, travel, hotel, dating, and music, they are still working in the structured space. Structured data, structured client data, and structured transaction data. And the same thing goes for banks, of course. When we look at the efforts where we have used large amounts of data, because with our definition of big data is in constant flux. It's relative to our capabilities. We can see that the efforts have been primarily where we had most bang for the buck, such as, for instance, anomaly detection, fraud detection, and so on. That's been ongoing forever, at least for decades, on banks' transaction data and also within the card companies. Within the front office activities of the banks, not much has happened, to be honest, within the banks. We can be fairly unimpressed. Why is that? Maybe because banks tend to focus on the mandatory tasks, regulation, MiFID, stuff like that. So all of the efforts to basically look outside and replicate what people are doing in other industries has become secondary within the banks. And there may be another reason as well, and that is because the banks, they are working on old legacy systems, and a lot of their efforts are geared towards patching up these systems and not preventing them from breaking down, basically. Also, banks tend to have huge IT projects. People talk about agility and being agile, etc., but the truth is most banks, they have multi-year IT projects, pre-studies that cost them hundreds of thousands of dollars, etc. That is something that is completely different if you look in other typical online companies. If we look at truly digital companies, you know what the banks say? The banks say that we're digital companies, we're actually tech companies with banking services, etc. It's not really true. Consultants have been telling banks for at least 10 years to look outside their own industry to get the impulse to become more agile. If we look at these companies like Tinder and Spotify, they analyze constantly hundreds of millions of events in order to stay one step ahead of their connected clients. And they experiment a lot, and they do it in very short project cycles. So if they can optimize the online vending model, which is at the core of their business model, they will modify the core system within the space of 7 to 14 days. In my mind, with my definition, big data has failed to deliver on its hype. And why is that? I walked yesterday on Broadway and I saw this poster. And I thought it was interesting about vision and reality. So I thought that big data, vision running ahead of reality, which is quite normal. In the dot-com boom in the 90s, we saw companies go under. They were too optimistic. Why? Not all necessary conditions for success were in place. At that time, connectivity was very low. Today, connectivity is very high. You've seen this hype cycle, fairly well known. And it's not only in the dot-com boom, you can see it with a lot of things that people get excited about, like robo-advisory, for instance. We may pretend that robo-advisory has taken on in a very big way, but it hasn't. Why? There's one piece missing. In order to make robo-advisory be a really, really big hit, we need to operate with models, for instance, that apply different kind of risk metrics, different kind of risk measures than we currently use. Currently, most models, they use portfolio theory model, which is typically a single horizon. But what do we do when we have, for instance, clients and we want to advise them on different additions to their portfolio, and each addition might have different time horizons? I'm involved in a project called the Suitability Reference Project, and that is a project, an academic project, which operates with or try to investigate new solutions to this problem, basically. My prediction is that robo-advisory will be super big once we cross that hurdle. Then we will have models that will allow banks to actually prevent hard evidence 10 years after the advice was given in a court of general jurisdiction, providing proof that at the time when the advice was given to this particular client, it was suitable to the best of anyone's knowledge at the time. That is what is needed to make robo-advisory a success. We are here, so, in my view. So the trough of disillusion, big data, it's a buzzword. You must see all these guys who've never done it in practice or all over LinkedIn and social media saying it's a buzzword and this is the new thing, etc. Why are we here? It's a challenge of dealing with the reality of unstructured data, and basically large streams of unstructured language data. So in the big data stack, 80% or more is unstructured language data. And the whole data stack is growing at a pace where it has a doubling rate of about 24 months. So the data explosion is ahead of us, and people are extremely productive online. And when you talk about the hidden gems in the big data stack, it's probably down there, under the surface. That is what we want to catch. Can we do that today? I would say no. Or you can go and ask companies like Hewlett & Packard. I don't know if there's anyone from Hewlett & Packard here, but they bought Autonomy. Autonomy was the leader, perceived leader in the field, the biggest buyer of IT hardware in Europe, a UK-based firm, allegedly analyzing and extracting actionable intelligence out of unstructured language data. The only problem was that their model was not scalable. People are extremely productive, and internet is no longer only in English. We have 200 million plus words in English on the internet. That's far more than you will have in any dictionary, and that is without counting all alternative spellings and misspellings. Third question, will big data deliver on its hype? Yes, I don't know if you in the back can read this slide. It's a bit, I could have used bigger font. I'm convinced. Why? There's a confluence of three important trends. The first is the data explosion with its doubling rate of 24 months. The second is the smartphone proliferation across the globe. People are extremely productive, and they're also much more connected. So the younger users, on average, they look at their smartphone 150 times a day, once every 6 minutes. The most important thing, however, and the sort of missing leg in the equation, with an analogy to the robo-advisory thing that I was talking about, is that right now we're seeing the emergence of machines that are learning to read and understand within situation marks unstructured language data on a very large scale. This is the key thing, and it's happening now. So despite what we may believe, these technologies have not been prevalent during the build-up of this big data hype. So this confluence, the fact that these things are happening now, this missing piece in the jigsaw is falling into place, is actually the big enabler that will make big data and big data analytics, prediction analytics, sentiment analysis, etc., to over-deliver on its hype and to transform most industries, including the investment industry and the banking industry. So what are these breakthroughs more in detail? It's about understanding the meaning of words. Why is it important? Because in order to understand the meaning of a word, you have to put it into context. If I say, that's a bad shirt, man, it doesn't mean that the shirt is bad, like an inflation number is bad. It means the shirt is awesome. That is why good can be bad, etc. It's very important to understand this, and it also explains why most models that we have that count raw frequency of co-occurrence of keywords from word lists are useless, generally speaking. They can be used for some tasks, but in order to attack this big chunk of data that is what we call the big data stack that is under the surface, they're not very helpful. A modern machine with a modern technology is scalable, i.e. it doesn't use classical statistical methods. They use modern methodologies like word spaces, vector spaces, random indexing, models that are infinitely scalable. If such a machine, where you stream the whole internet, all open URLs on the internet through a machine of that kind, and the machine sees, it's unsupervised, the machine sees the word for the first time. Even if it's a code word or a fantasy word. We invent a word right here. We invent the word cluck, Q-L-U-Q. Machine sees the word cluck in an utterance somewhere on the internet the first time. Cluck is good. Okay, cluck is something that is good. Cluck is happy. Cluck is angry. Cluck is obviously something that can harbor a feeling. Cluck is wagging his tail. Cluck was chasing the mailman. So what is cluck? What do you think? A dog. Possibly a dog. The machine in the word space will put the term cluck close to the concept of a dog. That's how they learn. It's very popular these days to talk about language technology, ontology, methods, etc. I was out in Silicon Valley and heard that there were about 2,000 startups now working with modern language technology tools. A lot of this A lot of these methods and technology, they've come up in private companies, in small labs, government labs, university labs, etc., sometimes funded by this, after 9/11, this big dream of total information awareness, etc. Ironically, the terrorists are no longer on the internet, but something good is coming out of this. Okay, so we look at big data predictive analytics. We know these days we can predict down to constituency level just by reading all open sources on the internet, the most likable outcome in, for instance, presidential elections. We can predict what the consumer confidence number will be. I mean, Google can look what people are searching for down on a very sort of granular level in a particular area. Are they Googling for Ferraris or BMWs or for unemployment benefits? Magic or open source intelligence. Okay, so we apply methods developed within the sphere of signal intelligence on open sources. And you know that today you can buy open source data in packages and streaming from a lot of vendors. This is a Swedish firm, a spin-off from a government, from a defense lab, and they predicted the surprise outcome in the Greek elections. In Greece, you cannot, it's against the law to do polls prior to the elections because you don't want to influence it. But they read everything in Greek on the internet, and they saw basically how opinions totally turned a few hours before the polls closed. Who is this guy? His name is Thomas Neuwirth, but he's more known as Conchita Wurst. That's his stage drag name. Why is he interesting? He won the European song contest called Eurovision. Why is it interesting? Because it has hundreds of millions of viewers, and people talk a lot about it on the internet. You can actually predict the outcome of an event like that. And not only that, a company which is also a spin-off from a defense lab, they have only made one public display of their capabilities because they wanted to show off. They said, we will predict the distribution of viewer votes in the Swedish semi-final to the Eurovision Song Contest. And they were so confident in their prediction that they had their prediction published in Sweden's biggest daily 1 day prior to the actual contest. And it was accurate. It was accurate for all 10 contenders, down to 1% for each one of them. Which of course led to a debate about whether the whole contest was rigged. Okay, in production, now we're talking about investment industry. The mysteries of monetizing, blah, 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 from data to dollars. You heard about all these Twitter funds, etc. Is it for real? There's a huge difference between predicting the outcome in a parliamentary election and predicting the price formation for financial assets. Why? It may not mean very much what 20,000 bloggers think about the euro USD if you have some hedge fund managers in Connecticut or here in Wall Street who thinks differently. So the price formation for financial assets are, as you know, it's always capital weighted. Most of the approaches that you see out there, generally speaking, they don't work. And I'm involved in lots of projects where we do studies of this, and we can actually prove why they don't work. Simple as that. But there are other things that work with modern language technologies. With much better text analysis, you get much better sentiments and you get much better predictions. How can that be? Okay, an analogy to weather forecasting. Over the last couple of decades, the accuracy in weather forecasting has gone up dramatically. Why? Because you have a lot more data, a lot more granular data, and a lot more history. And you have machines that can discover patterns in that data, patterns far beyond human cognition. And that's what you're trying to do. We have several studies, but we have one in open display on the internet. Under the web address is whatismonitor.com, where we actually, it's an open prospective study of predictions for financial assets. And we have people all over the world following this one. It's been extremely impressive, and it has attracted enormous attention. You can look it up, and the whole record is there. So everything that has been, predictions are being publicized every day at 4 o'clock CET from allegedly predictive models, and they seem to have predictive powers. How does it work in distribution? So that was basically alpha creation. Now we come into distribution. Distribution of financial products. We may think, and our mothers may think, that we are special, and we may be special, but we're not very different. I mean, not from a global perspective. What does it mean? It means that if we just leave a few digital footprints on the internet, a machine can generalize who we are with a high degree of accuracy. I mean, generally speaking, statistically. We're talking about basically statistics here. The Watson personality profile, you may have seen it. You just tap in a text. The same thing you can do if you want to, if you are the police. You take someone's hard drive, you look at all the text that they have produced, and you can actually, machine can understand what has been produced and what has been copied and pasted. Okay? So there's something called semantic fingerprinting. And it's also a fantastic technique nowadays for alias matching. So if you have me, for instance, I may be Lars Hamburg here, and on some other venue, Tinder, I may be, I don't know, Hot Viking or something like that. Bad Boy 86. 68 doesn't sound so good. Okay, so, and this other thing, we have the semantic fingerprint to the right here. That is actually from a known criminal, Anders Behring Breivik, the mass shooter in Norway. And these fingerprints are actually rather accurate. So you can match profiles and stuff like that. And with a few snippets of data, you can get a lot of information about the person. And how do you use that? Well, you use that, of course, in order to market your products. What we've seen so far is basically, or actually I'll hop along here. When it comes to the distribution here, we see common denominations for success. I was involved in a project in a bank, and in Sweden we were earlier than any other country in terms of connectivity, digital banking, and so on. So way back, everyone was on online banking. Of course, it's just a method or a way for banks to cut cost. But banks have been reasonably slow, with some exceptions, to do anything sensible with this. But when you have all the transaction data, you can, for instance, I mean, the traditional method, if you want to do marketing, you have like 4 issues, let's say, of a credit product every year, and you look at who bought it the last time. That's a simple analysis. It doesn't have to do with machine learning in any way. But what you can do, if you look for patterns within those who actually bought it, and then you look at patterns, hidden patterns or hidden variables in that group or subpopulation that were most profitable. And then you go out in your whole client base and you look for those traits in particular. Then there have been cases where we've just seen profitability just go through the roof. When that happens, it becomes the bank's management pet project. Forget about compliance, credit. This is what we're going to do. The only negative thing about it is that they keep it secret. It's the management secret pet project. So the knowledge is not being transferred to other banks, and people keep making the same mistakes. One common mistake that people do is that they just invest too much, too big projects. These projects, when successful, they're super small, they're very close to the front office, done in very small cycles, and they're very cheap. Same thing here with the production, alpha creation, etc. You must know what you're doing. I'm going back to this thing with these studies that we've seen. Success, of course, use modern methods. Failure, just buy something off the shelf that is, the sentiment analysis software of choice. If you buy something that is not state-of-the-art, you will have a very hard time getting anywhere with just looking at the raw frequency of co-occurrence of keywords like positive and negative keywords. Okay, question 4. The impact of big data on your business. From what I've seen, it's going to be huge. Transformative is how people talk about uniquely positioned and transformative, but this will be truly transformative. I think it will be as transformative as the mobile phone or the computer or the telegraph, things like that. The subatlantic cable. The ones that adopt early, they have it, okay, and in this shift, they gain a competitive position. Others that are slower, they will lose out on a relative basis. After a while, it will become old hat, standard, everyone will have it. Nowadays, it's very hard to imagine, how did the finance business work before computers or before telephones, okay? But this is happening now, okay? Winners and losers like in all major shifts. But I think it's with the development of language technology, some of the capabilities will be truly surprising. So the key takeaways here, there's too small to read for you in the back, but I will see if we can maybe PDF this and put it on some site or something. And that's the outlook, basically. So someone is looking out and can say the future for predictive analytics in banking looks very bright, in my view. And I'm happy to take questions if you have any. And I can also add that I will be around. I will be around the whole day today and tomorrow. Yes?
You made an interesting point when you talked about how digital, a lot of times traditionally I think it's seen as an innovation, but for a lot of banks it's actually more costly. Can you maybe talk a little bit more about that, the banks that have done it right and some ones that maybe try to fly before they fall?
Yes, it's been very rational for banks to use advanced analytics in general as a shield, okay? And not as a sword. You should use it as a sword as well. And now when people talk about digital in banking, and you look at some people that do it right, most banks now, because it's very popular to tell shareholders that digitalization and digitization, or whatever they call it, we're tech companies, etc., and we have an innovation lab. One trend that we can see is, of course, that some innovation labs are not sort of left alone. You should leave them alone. They should be rather autonomous in the bank and not fall into basically the institutionalized nature of a big bank. What else can we see? We can see that people talk a lot about, in this context, people talk a lot about fintech. Okay? So there's some kind of convergence here. Fintech, a threat from fintech. I think it's totally it's exaggerated, because you have a lot of fintech firms, and of course there will be a consolidation. So banks will look outside. They see something that works technology-wise, okay, and that could fit into a bank. Of course they will buy it. They will mimic it or copy it or buy it. And I think that is, if you take sort of the winners from the losers, the ones that are doing it right, they are basically eyeing fintech companies and they will swoop them up. The ones that have done it particularly right are actually the ones that have had this revelation on a management level. So now, for instance, one bank that is, it's a very modern bank, everything modern, electronic, very progressive, etc. But they're in their IT department, they never had the culture of running small, agile projects, okay? They may say that we're agile, but most of them aren't, okay? But when they truly started to have, basically allocate some developers from their IT department to be sort of, we call it floating around, like freestyling, together with the front office, and they formulate a particular task, like how can we increase the profitability within this particular product line? It's not something that's going to transform, that particular task is not going to transform the whole bank. But it will become a very good example of how with an investment of maybe $50,000 or $100,000 in total, can increase profitability enormously. Once that happens, management sees that, they say, this is the way to go. So they're starting to have, the successful ones are starting to have sort of a two-track development. They have the traditional multi-year project cycles, and they have these small freestyling teams.
But you've seen that the banks that are doing it right, the equity point of how they kind of that they're using the 3M rule, which is the 50% time sort of outcome innovation, or they not that.
I haven't seen it that formalized. But I think this, I mean, I'd say if we look out a couple of months, or I'm a time optimist, let's say we look out a year, I think this will be a very hot topic about basically how, from a sort of cultural context, do you fit in these kind of projects in the banks. Why will it become urgent? Because I know some, for instance, some IT firms where they have said, we want to use this as an example when we go out and pitch to other banks. And the bank's management, their principal, said, no, we keep it undercover. So that's sort of the drawback here. That some people think that they have discovered sort of the golden egg.
Right.
Yes.
Don't want to monopolize time here. One other question, you talked about reporting structure. I think that's something that's interesting to note, that chief data officer, you want to get a better understanding across companies. Do you find that you're typically reporting the chief operating officer or the chief financial officer, or sort of a kind of a mix across the board?
Well, it's interesting because I think about two things, so then I will finish, but they're not that evolved yet. I mean, they have these big projects, and it's sort of ingrained in them. And still in a bank, if you look at CDO, you go to a bank and you say, what's a CDO? They don't say Chief Data Officer, there's a collateralized debt obligation, right? And it's interesting, while you have all of these companies with fairly competitive businesses, like travel online, etc., the Tinders, the dating industry, etc., some of them have much more advanced analytics, okay, and higher, better analysts than many banks. They also go through fantastic extremes and efforts just to know their clients better. And ironically, if you think about it, the banking industry is the only industry, at least that I know of, where the regulator has to step in and order the operators to know their client. Know your client, or we will punish you. And if you put that in some kind of perspective, not only from reputation loss, but also loss to business opportunity, I find it totally amazing. Thank you very much.